All right, everybody, here to talk to you about about mortgage interest rates and the effect the rising rates are having on home values. First of all, when interest rates were dropping to record lows, that would enable people to borrow more and more and more, because you get approved to borrow a loan based on what you can afford in a monthly payment. So if you could afford $1,500, you could afford, a month, you could afford this much of a loan. Well, as interest rates go down, you could afford even more and more and more. And that helped propel the dramatic increase in home values. But now the opposite is happening, and it's happening quicker. Interest rates are being driven up quicker than they were driven down. So it's going to be a dramatic effect on real estate values, and I personally feel every square inch of real estate in the United States of America is going to see some level of price drop. It may just be 3 to 5%, but some areas may be 20% or more. Because you have to think about it, the whole big picture. Everybody's borrowing power is going down, including Bill Gates. Bill Gates today can borrow less than he could a year ago. I mean, that's just simple. So, just to give an illustration here, now interest rates got to, I think mortgage rates, the lowest I saw was 2.65%, but I'll just use 3% as my number here to simplify it. So anyways, a year ago you could borrow $300,000 at 3%, and that would be a monthly payment of $1,265. But today, mortgage rates are, due to the Federal Reserve raising the Fed funds rate, which affects the bond rates, which affects mortgage interest rates. Today, a $300,000 loan at 7.5% is going to cost $2,100 a month. That's a 66% hike from this payment to this payment. Now, the person that got approved for a loan based on that they could afford this amount of a payment per month is simply not going to be able to still get a $300,000 loan because they can't afford that payment. So, I will show you what this person, if they will still get what they can still borrow based on this payment amount, the amount that they can borrow has now dropped 40% to $180,000. So if you can afford to pay up to $1,265, now the interest rates are averaging 7.5%. The most you're going to be able to borrow is $180,000. That's a 40% drop from $300,000. Now let me, again, you have to look at the big picture. It's not just this one person, that's every single citizen. Every single citizen, no matter how wealthy you are, your borrowing power has gone down dramatically. So to say this is not going to affect real estate prices, some people out there are still saying, like here in Denver, some people feel that there won't be any price drop here in Denver. Totally disagree with that. Now, maybe the price drop here in Denver will be less than a hot city like Nashville. Nashville will probably see a bigger price drop. But every square inch of real estate in the United States is going to see some level of price drop because everyone's borrowing power is going down, and going down dramatically, going down 40%. That's a huge drop. Like I say, some areas could be 3 to 5% drop, some areas could be more than 20%. But again, look at that illustration. Look how dramatic of a drop, that is. This is what this person you could have borrowed a year ago, and now it's dropped to that. So it's really going to have a dramatic effect on the real estate market, and even home builders are discounting homes. They're trying to, now different home builders are competing against each other. They got to unload finished homes that don't, have any contracts yet. So they're dropping prices on those to try and offload them before they're stuck with these built homes with no buyers. So again, just wanted to illustrate what's going on in this increasing interest rate environment, and it'll be interesting to see how this plays out. But for this person, don't freak out, because you don't want to say, oh, I should have gone in when it was here. No, I'd rather pay a higher interest rate on a smaller loan. I'd rather pay 7.5% on a $180,000 house than 3% on a $300,000 house, because your profit is what you pay. Because someday maybe that $180,000 house will rise to a value of $250,000, so they could sell it for a $70,000 profit. But the person that bought the home at $300,000, maybe their home's going to drop to $250,000. So if they sell it, they'll have to come up with 50 grand, because unless they have $50,000 in equity. But because I would always hear people say, oh, you got to buy a home while interest rates are still low. No, you don't want to jump on any bandwagons. Just chill and wait. As homes sell for lower prices, it's going to be a slow process. But as homes sell one by one, like in this neighborhood, if a house sells for a 10% lower than they originally would have, then that kind of sets a precedence for what the homes around them are worth. And then as more homes sell for lower prices, then that's going to devalue the homes around them. So anyways, that's my little bit on mortgage interest rates, and it's going to be interesting to see how this plays out. So have a good day, everybody.